So I get the feeling that some people think that a stock is just this thing that gets traded on a computer screen and the price goes up and down and people get wildly rich off of it. And to some extent, that can be true. But today I really wanted to talk about what a stock is, how a stock gets valued, and what makes the price go up and down. So let's get started. So what is a stock? A stock basically just represents a piece of ownership in a business. And I'll try to solidify this concept with a super simple example. And let's just say that you start a lemonade stand business and you're selling lemonade in your neighborhood and you are continuing to grow that business and you want to start investing in some things like maybe it's new equipment to help you make the lemonade or get some employees or buy a bigger stand so that people will see your lemonade stand and want to buy more lemonade or something of the like. So one of your options as an owner of the business is to sell part of your business in order to raise money to go out and do those things that we talked about. So let's just say that you, as an owner of the business, decide to go that route and you divide your company into 100 shares and you value them at $1 each. Now let's just say that you have a friend who's interested in buying some ownership in your company and you need to raise $50, so you sell them 50 shares at $1 each or $50 to help raise money for the growth opportunities that you have. So there it is. You sold your company to your friend. Now they have ownership in the business, which means that if things go well, they will participate in the upside or the value of their stock will go up. And if things don't go well, they share in the downside as well, meaning that their shares could be worthless in the end. Now, because you sold some shares of your business to your friend, they get voting rights. And what can they vote on? They can vote on things like expanding the business, or reinvesting the profits from the business in order to grow it more, or distributing profits of the business to the shareholders, which would be you and your friend. Now I want to make one thing clear, which is something that I wasn't totally clear on when I was first learning about stocks. And the question is, why would you want to buy into a business that isn't distributing the profits of the business? Because you are the owner, and in theory, you should get distributed profits, right? So there's a couple of reasons for this, not an exhaustive list, but just to name a few. If you are reinvesting proceeds or profits of the business back into the business, in theory, your business should grow a lot more. And if it grows a lot more, then the value of the company should go up. So that's one reason. Another reason is that they might distribute profits in the future. So let's just say that the company grows to a point, you've kind of exhausted all of your growth. At that point, it probably makes more sense in the future to start distributing profits out to the shareholders of the business. So there's potential for future dividends. Another reason is that your company could get bought out. So let's just say that another company comes to yours and says, I'll buy you out for $200 total valuation. And remember that you have 100 shares, so that's a $2 per share valuation. Now you just issued shares to your friends at a $1 per share valuation or $100 total for your business. So that would be 100% profit for you as or your friend who just bought into shares of the business, which is appealing. And so that company would pay you $200 to buy your business. So you get cash at that point. So how do we actually value a stock? Well, there's a couple different methodologies that investors might use, and I'll cover a couple of those here. So the first one is a price to earnings ratio, and basically what this is somebody's looking at the value of the stock and comparing that to the earnings of the stock or the profit. So let's just say that investor says, I'll pay 10 times earnings or 12 times earnings. And that multiple is what we call the PE ratio. And oftentimes that multiple is based on the future growth prospects of the company. So the next methodology is a discounted cash flow, or what some people refer to as a DCF methodology. And basically what they're doing is they're projecting the future cash flows of the business and discounting them back to the present value in order to come up with a value of the business. The next methodology is a dividend discount model, or what some people refer to as DDM. And what this is let's just say that the company pays out profits to its shareholders. An investor might look at the future payouts of profits from the company and discount those back to the present value in order to come up with a value of the company. So the next valuation methodology is a price to sales method, and this is probably the simplest method that you'll encounter, but basically somebody's just assigning a multiple to the sales of the business. Another method is the price to book, and this just basically looks at the price of the stock compared to the assets that your business has, like inventory or cash on hand or anything else that your company owns. So those are some of the various methodologies that investors will use in order to value a stock, but just understand that different investors have different methodologies, and at the end of the day, the value of a stock is what someone is willing to pay for it. So stock prices go up and down based on how many people want to buy your stock versus how many people want to sell your stock. And if you're asking what causes that, let's go back to the lemonade stand example to help illustrate. So some things that would help improve the value of your lemonade stand business would be things like generating more revenue. So let's just say that more people are interested in buying lemonade and your sales go up as a result, and in theory your profit will go up as well, therefore increasing the value of your business. Another thing you can do is reduce expenses. Let's just say that you found a way to make your lemonade cheaper, and because you have found a way to make it cheaper, your profit of the business goes up, and therefore the value of the company also goes up because more people would be interested in more profit. Another reason is investor sentiment. So let's just say that for whatever reason, people get really interested in buying lemonade stand businesses. The fact that there's more people interested means there's higher demand for the stock, which means the value of the stock should go up. Another way to increase the value would be to increase your product offerings. So let's just say that you've decided to sell cookies as well as lemonade. Now this generates additional revenue for your business and in theory additional profit, which would help increase the value of your lemonade stand business. So what are some of the things that would decrease the value of your lemonade stand business? For one, it would be increased competition. So let's just say that your neighbor decides to start a lemonade stand, and because of that, some of your customers become their customers, meaning that your sales likely go down and therefore decrease the value of your business. Another reason would be increased expenses. So let's just say that there's a shortage of lemons and therefore the price of lemons goes up, which means you have increased expenses in your business and therefore the profit of your business goes down. Another reason would be consumer preferences. So let's just say all of a sudden people say, I don't want to buy lemonade anymore, I actually want to buy orange juice. Because they would generate fewer sales from your lemonade because people don't like your lemonade as much as they now like orange juice, the value of your business likely goes down. So these same concepts that can be applied to your lemonade stand business also apply to publicly traded stocks like Apple and Amazon and Google and so on and so forth. If things are going well, let's just say that the prospects of more revenue or earnings or investor sentiment is positive on the stock, then the value of the stock will go up. But similarly, if things are negative on the stock, then the value of the stock will go down. Alright, so let's sum this all up. A stock represents ownership in a business, much like owning shares of your lemonade stand business, and when you own stock, you have voting rights, which means you can help make key decisions on the trajectory of the business. And even without the company paying out any money to you as an owner of the business, you might buy into the business because of the growth potential of the business, or because it can get bought out in the future, or there's potential for dividends in the future. Now, stocks get valued using various methodologies such as price to earnings or price to sales or discounted cash flows, and stock prices go up or down based on growth of revenue or decrease of expenses or investor sentiment. And at the end of the day, stock prices aren't just things that go up and down on the screen. They're actually real businesses, and understanding why the value goes up or down is key to becoming a good investor. Now, if you found this video helpful, please make sure to like and subscribe. And if there's any other content you want me to cover on this channel, please drop a comment. And until then, we'll see you on the next one.